Hello, everyone. My guest today is Joe Coleman. He's a lifelong entrepreneur and founded two successful internet companies before his current company called Contently. In 2012, Joe and his co-founders were named to Inc.'s 30 Under 30 list. We'll dive in today. Joe, are you ready to take us to the top?
Yeah, let's do it.
All right. So first, tell us what Contently does, and then I want to talk about your growth.
Okay, cool. So Contently, our mission is to help companies drive business results with content that engages, educates, and builds trust with their users. And so what that means is, in practice, we built a content marketing solution primarily geared towards large enterprise brands, so the Fortune 500, those sorts of organizations. And what we're trying to help them do is we're helping trying to implement content marketing solutions that actually drive real results for their business. If you look into that a little bit further and think about what Contently does, there's two things that make us really special. One of the things is that we spent the first couple of years of our business building out a marketplace for freelance creatives, and that's actually how we got started. And so today that network is around 150,000 professional journalists, videographers, data researchers, visual designers, kind of any kind of talent that a brand might need to tell their story in a unique format is in that network, largest of its kind in the world. The second component to that is the software platform that we've been building for the last 5 or so years that actually helps brands streamline the content marketing process from start to finish. So not only do you have access to the talent, it's actually integrated into this enterprise software platform that helps you manage all the organizational change and all the process and sort of red tape and bureaucracy that often marketers run into inside of these big companies. So that's the value proposition at its core. We work with a big chunk of the Fortune 500, 7 of the 10 world's most valuable brands are our customers. We basically have categories like finance and insurance on lockdown. We do really well in B2B. Travel is a big emerging category for us, people like Marriott, IHG, those types of companies. So yeah, that's a sort of quick overview of
And Joe, when was year one? When did you launch?
We launched in January 2011. Officially is when we incorporated.
So 2011, as a marketplace, you scaled that marketplace up to the point where many of these folks that you've built, you said 150,000 I mean, they're building lives on top of the revenue you're paying them. You paid out over 20 million in 2016. What is that scaled to in 2017?
So it's well over $30 million now, mid 30 millions in terms of what we're actually paying these creatives each year, which is awesome. And like super rewarding component of the business, obviously, is not just are we helping brands tell more authentic stories and do marketing in a way that's less annoying, but we're also helping the media world by employing journalists and other types of customers through our freelance marketplace, through other sorts of content creators through our marketplace. So yeah, the number is pretty big and growing, and it's one of the cool parts about our business.
Before we shift to the software side, in case we have some of these content people listening today and they might be interested in joining, if you give them a project that's $1,000, how much gets paid through to them and how much do you keep?
So we take a pretty small rate of whatever the marketplace transactions are. It's typically around 15%. Okay. Depends on a few variables, but that's sort of where it falls. It's typically where it falls in line. Although that's, the way it's structured is that's sort of charged to the brand and not necessarily to the creative. So one of the things that's really important to us is that we're taking care of our freelance talent and making sure that we're making sure they get paid fairly, which was a big problem in the early days when you had content farms like Demand Media and Associated Content. And we do things like make sure that they get paid immediately on the submit of their first draft, which is night and day between what they're used to, where journalists will write a column for a magazine and then wait 90 days to get paid. So it's a great experience for our content creators. We make mistakes sometimes, but I think we've tried to design something that is very useful for them and trying to sort of set an example for what the future of media should be in many ways.
With that kind of knowledge, I mean, if you're paying out 30 million to these folks on an annual basis, it's fair to say I could increase that by about 15% and say you're doing about 33, 35 million in kind of project volume annually. Is that accurate?
So the $30 million, yeah, that's exactly right.
Yeah.
That's exactly right. The overall project volume.
Let's switch to the SaaS side, because I think this is probably much higher margin and probably faster growing. When did you introduce a SaaS model? Because obviously you started as a marketplace.
Mm-hmm. Yeah. So the way it worked was, it was kind of a, well, it's actually the way these things should happen, which is that we started building out the marketplace. One of the things we did in the early days to solve the chicken or the egg problem with the marketplace was we ended up building portfolios for for journalists. Scott Belsky, who at the time was running a company called Behance, before he sold it to Adobe. He was one of our investors, and he basically said, portfolio tool like Behance should exist for journalists, and he wasn't going to build it, so he's like, you guys should build it. And so we did that, and we created a really awesome way for journalists to sign up to Contently and display their work in a way that was super unique and compelling versus a paper resume or a LinkedIn site. And so that took off in the early days. It helped us build out our network of talent. So we really scaled the supply side of the marketplace pretty quickly. And then we started looking at, okay, now that we have the writers, how do we think about the demand side of the marketplace, the brands, the media companies, all these people that wanted to tap into this network. And what ended up happening was we started working with bigger and bigger companies. American Express and Coca-Cola were two of our early customers. And what we realized pretty quickly was that the marketers over there had a lot of other problems that went beyond just finding talent. Yep. And so we were talking to our contact at Amex, and they had like 7 lawyers that needed to look at the piece of content before it could go live, which was shocking to us because we had never worked at a big company. But she was like, yeah, we create this content, has to go through this process of just endless revisions and reviews. And as a result, a lot of the content that gets produced doesn't even ever see the light of day. And so looking at that kind of case study and a few other things, we realized that we could actually solve a lot of those problems with software. First and foremost, by getting them out of email and Excel spreadsheets and Google Docs and those kinds of things, and actually building a customized tool for content development, content marketing that would help them easily manage the approvals and sign-offs and editing process involved in content marketing. So that's where we got our start. As we started thinking about more and more of these problems.
Joe, sorry, what year was that? Yeah. So 2011 was year one. When did the SaaS stuff start bubbling up?
It was end of 2012 that we really started building out actual software beyond just the software that kind of enabled the marketplace.
Okay, great.
So, year and a half, 2 years.
And then if we fast forward to today, these brands you're working with, you've mentioned some of the big ones, but give me a general sense of what they pay per month on average and what are they getting? What's the software delivered to them for that price?
Mm-hmm. The average customer typically starts with a subscription that's somewhere around $60K in ACV, and that's just on subscription fees. And then the average brand will typically do about 20%, 25% of their average annual subscription fee. We'll get about 25% of that back in content revenue, which means that the customer is doing more content or spending more money on content in the marketplace than they are on the subscription, which is a very important metric for us when we think about account health. So that's typically what they're paying up front when they get started. What they're getting is they're getting access to obviously the network of creative talent. They're getting access to the software itself. We do have some feature discrimination in our pricing, but typically our motto is really, first of all, we've tried things like per user pricing and all of that stuff. And I've come to the conclusion that it just doesn't work very well in MarTech in general, but, particularly in a business like ours where we want as many people on the system as we can getting value out of Contently. And so we have unlimited users. You get access to the creation suite that allows content to be produced inside the platform, whether it's our marketplace or your creatives. That includes things like payments and handling legal and all those things that are a pain for organizations to deal with internally. We take care of all of that for them. At a high level, there's tons of stuff in the system, but at a high level, we also help them manage the distribution process, publishing the content to where it needs to go, getting it in front of the right place at the right time, the right people at the right place at the right time, and then finally a lot to do with analytics and helping them understand the performance of their content, how they can do better next time.
And how many customers have you scaled to on the SaaS side of things today?
On the SaaS side of things, it's around 200.
Okay, so very much an enterprise sale.
Yeah.
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 Go ahead.
No, I didn't have anything else. I just said, yes, it is very much an enterprise sell.
Yeah. And then in terms of, again, where that's at, if I take $200 and that minimum ACV you just said, I mean, that puts you well north of $1 million a month. I know you're north of that because you guys, congratulations, continue to make the Inc. list. And it sounds like you did about 21.3 million in 2016 revenue. Where are you guys at today?
So we're ahead of that. It depends again on how you calculate it. So when you look at just pure SaaS subscription revenue, we'll end the year at about on a $20 million or so run rate. And then the content component of that is quite a bit larger. So this gets into accounting rules and ways that companies sort of count their revenue. What we've decided to do recently is not count the 85% of the dollar that goes to the writer. We just count it as pass-through now. And so we count only the 15% that we take. What that means is that we have a business with smaller revenue, but much higher gross margins, which is really, I think, the way that it should sort of be done anyway. So
yeah, Joe, people game this though all the time. I like that you've taken the approach that you've done. I think what I hear you saying is like some other companies might report this as 20 million in ARR from the SaaS side. And then instead of saying 3 million from the percent you take on the marketplace, they would say 33 million on top of that for 53 million in total revenue. But your margins are shit because 30 million goes out the door immediately to pay the freelancers, the creators.
Yeah, totally. Yeah, it's smoke and mirrors basically.
Yeah. So if we get kind of your true thing with high margins, you got 20 million in ARR and another, call it 3 to 5, which is your cut of the marketplace revenue.
Right.
That's great. Bootstrapped or have you raised capital?
What's that?
Bootstrapped or have you raised?
No. We've definitely raised capital. We've raised about $20 million in equity over the last 7 years or so.
When was the last round?
Last round was end of 2016.
Okay.
So it's actually one of the things that we're super proud of at Contently is if you look at the space more broadly, we're neck and neck with a lot of our competition that has raised like $90 million, $60 million, $40 million. And my background as an entrepreneur, the 2 companies I built before this were all bootstrapped. And so I just have a completely different way of thinking about things, I think, than a lot of entrepreneurs that have only worked in businesses that were capitalized through venture capital or some other sort of mechanism. And so we've always been very efficient. We've always been very, very lean. And it's awesome because now we're looking at a business that's growing quickly and we're going to be in a position to take on more capital if we want. We're also depending on.
Hold on, Joe. Sorry, before you move away from that comment. So real quick, what are you growing at right now? Just on the SaaS side, you're at 1.6 million a month today. Where were you a year ago?
Where were we a year ago on the SaaS side? That's a good. I would assume that we were around 1.2 probably.
Yep.
Maybe 1.1, something like that. So at this scale, you try to be above a 40% annual growth rate is kind of the benchmark that you want to hit is continue keeping up the 40% growth rate. Last year we were a little bit behind that. We had a lot of rebuilding we had to do last year with respect to the exec team and so forth. And then this year is sort of looking much better. So,
and what are you at team size wise today?
Team size wise, we're just over 100. Okay.
And everyone based in New York?
Most are based in New York. We have a sales team out in San Francisco, and then we have a team that's sales and customer success.
And would my assumption that you're cash flow positive be correct since the last time you raised capital was so long ago?
No. So we actually, we are burning cash. We're not burning a lot. We're in a position where, we like to keep that option on the table. And our pathway to profitability is pretty clear. However, we spent so much time last year getting our sales and marketing machine in a good place that we all agree, including the board, that just makes sense to lean into some of the success we're seeing. So spending more on marketing, hiring more salespeople, doing all those things that you can do comfortably once you've figured out a lot of the underlying components of the sales and marketing machine.
What I think, Joe, I hear you saying is if you needed to be profitable, you could very easily do so by trimming some of the variable marketing expenses versus cutting any kind of muscle.
Yeah, certainly, if we wanted to be profitable tomorrow, it would be much more painful than say if we wanted to be profitable in 6 months from now. But
sure.
There's no real reason for us to do that because cash isn't really an issue for us right now.
Yeah. So I want to talk more a little bit about economics and how you use those economics to build out that sales engine you just said. So walk me through a little bit. Churn is obviously critical in a SaaS company. What's your churn today?
So our churn across the board, this has been something we've been working a lot on. In last quarter, it was 71% gross retention and about 90% net retention.
Okay.
So we still have more room to work there. For an enterprise business, you kind of want to have, at the end of the day, you want to have 90% gross retention and then net negative churn,
yep.
At least from a dollar standpoint. Where we are is, if you look at our business, we still have a component of the business that isn't the enterprise tier. It's sort of smaller businesses, high growth tech. A lot of these companies we took on because we thought we could serve them well. And history has shown that in many cases, they're just not good customers for us. So for the last 18 months, we've been very much focusing on getting our customer mix right, getting it to be the kind of customers where we do really well, Fortune 500. And when you look at that cohort, we're at 90+% gross retention and then net negative on the MRR churn side. So we're in a really good place. Our work today is to get the existing base of customers that aren't there yet and either move them out if they're too small or work with them to get them to sort of join this pool of companies that are using the solution in the right way that kind of increases retention across the board.
And just to be clear, the numbers you just gave me, 71% gross retention, 90% net retention from a quarterly perspective, those are both dollar figures, not logo numbers, right?
Yeah, that's right. Our or our logo retention is actually much better, but it's useful, but it's not nearly as useful as tracking dollar retention.
Wait, Joe, that confuses me. If you're focused on enterprise accounts, typically your revenue retention will be way higher than your logo retention because you're churning lower paying customers paying you way less.
Say that again.
When you just said that, maybe I misheard you. I thought I just heard you say that your logo churn was way. Sorry, you're on a logo basis. You're retaining way more than what your revenue retention is. Is that accurate?
Yeah.
If that's the case, yeah.
So here's why that is, because many of our larger customers were working inside of several different divisions. So someone like JP Morgan, we're managing 12 different lines of business through there. RBC has, I think, 13 different lines of business. We just signed a deal with Rico where we're powering 16 different lines of business. And so what happens inside these organizations from quarter to quarter is you may lose one of those divisions. And you may lose two of the divisions, but you still have 5 other divisions that are working within that brand. And so that means that you keep the logo, even though you're shedding some of the MRR, you're shedding some of the dollar churn. You know what I mean? So it's possible to have, dollar churn that isn't great, but you still have the same customer set because you're working in other categories or other departments within those organizations.
Yeah, my brain was in a different spot. That makes total sense what you just said in terms of kind of downgrade perspective, and that would obviously shed light on why revenue retention could be lower than logo retention. But I thought I heard you say that you have a lot of people on lower price tiers, and you don't mind them churning, and those are logos kind of churning on lower price tiers. That's what drove my thought process there.
Yeah, so it's interesting. The lower price, the lower tiers of companies that are smaller, they actually weren't paying that much less than the big brands, which is interesting and I think says a lot about the market. So it did hurt when we lost a lot of those guys. And, a lot of what we've had to do is just sort of reorient our pricing because this was a new market. It still is a new market. And as a result, figuring out what pricing should be, a lot of it is trial and error. Like you literally, in the early days, we were just picking out numbers, and if people paid for it, then we just charge more. And we just had to go through that process to figure out what the right pricing is for the market. Yep. So yeah.
What's your last few economics questions here before we wrap up with the famous 5? CAC, what are you paying right now to acquire new customers? Fully weighted.
Right now it's about 40,000.
Okay.
It sort of goes between 30 and 50K. We obviously like to keep it quite a bit lower, but we also operate on fully loaded figures. So whenever you build out a marketing function or invest in things that aren't just variable ad spend and so forth, you're going to take a little bit of a hit there in terms of CAC. But they
Joe, I feel like you're hedging this, but if you're paying that and they're coming on at $5,000 a month, your payback is 8 months, which is totally healthy for a company in your spot. Why do you feel like that? Why are you, am I reading right that you're hedging there?
Yeah, I mean, I am. Obviously, you want as low payback as you can get, right? It'd be great if our payback was 3 months.
Of course.
And sometimes it has been. But yeah, you're totally right. I mean, our payback, it swings anywhere between, 6 months and a year, sort of depending on how we do that quarter and those kinds of things. But yeah, our view is, as long as it's under a year, I think that the business definitely deserves investment and those kinds of things. So
yep,
we're in a pretty good spot with that.
Are you raising capital right now?
We're not raising capital right now. Yeah, we're in a position now where we're really fine tuning our sales and marketing machine. 17, we built an excellent marketing team. We also brought in a really strong sales leader and have since then hired a really strong sales team. The thing about enterprise sales, it sucks, is you have long ramp up times for reps. Deals take a while to close. And so you do all this great work to get the thing in place, and then you got to wait a little while to see all those results. And so we're anticipating kind of end of Q4 this year, Q1 19, when things are really going to start taking off for us, and all that hard work we did figuring out the formulas for sales and marketing are really gonna take off for us, and then we'll likely look at another round of funding.
All right, Joe, let's wrap up here with the famous 5. Number 1, what's your favorite business book?
That's a good question.
If you don't have one, don't make one up. That's okay.
I guess I'd have to say the Blue Ocean Strategy. I'm a big fan of that one.
Number 2, is there a CEO you're following or studying right now?
Yeah, it's a weird question. Yeah. So I'm going to make a fool of myself because I can't remember how to say his name, but it's like Satya Nadella from
Satya Nadella.
Yeah. I'm fascinated by the work that he's done and just how different he is from a DNA perspective than his predecessor, and love the way they're going. I've also, closer to home, I've been thinking a lot about there's a company here called Taboola, and I'm friendly with their CEO, Adam Singola, who was actually one of the guys that first helped us in the early days and believed in us. And last time I saw him, he talked about how his company is so big now that he's just spending a lot of time thinking about how can he add his unique value. And that's just something that resonated with me so much, because at a certain point as a CEO, you have so many good people around you that can do a lot of great things that it's like, what should I do? How should I spend my time? And you're really forced to think about, where am I uniquely good? And how can I maximize the amount of time that I'm doing those things? And so I've been thinking a lot about that meeting and some of the things he said there just as a CEO.
Good. Number 3, what's your favorite online tool for building the business?
Well, I would recommend Contently highly.
Besides your own.
I would also say, I mean, from a pure necessity standpoint, Salesforce, I think, is obviously very important. I think the G Suite is also very, very awesome for, building out teams and managing those guys. And then fun one I found recently is Standard Notes, which is basically an awesome note-taking tool that has lots of extensions, and you can do lots of fun stuff with it, and just personally managing my own stuff.
Number 4, Joe, how many hours of sleep do you get every night?
Oh man, I probably get 7.
Good. Very good. That's healthy.
Yeah.
And what's your situation? Married, single, kiddos?
I'm married and I have a 18-month-old at home.
Oh, wow. Okay. So, and how old are you?
34.
34. Okay. Last question. What do you wish your 20-year-old self knew?
Let's see. I wish I knew not to buy that condo in Las Vegas in 2006. But apart from that, I guess I would say, I really wish I knew that exactly what you're getting into when you start a venture-backed company. And it's impossible for people like me to know at that stage. But, it's a huge commitment. And especially if you're successful, it's an enormous commitment. And don't get me wrong, I've thoroughly enjoyed it. But you have no idea what you're in for in terms of insanity and stress and just all of the stuff that goes with it. So maybe I actually don't wish I knew that, because I'm not sure I would have done it. yeah, it is. There's a lot more than you initially think about when you think about starting a business. Again, especially if you're successful.
Guys, there you have it from Joe, created in 2011 as a marketplace to help really creators, writers, video people, photo people create content at scale and really get linked up with people that needed their content. Marketplace grew substantially. Now today they pay out over $30 million a year to these creators. They make $3 million on that 30, so only 15%. They really send most of that through. Where they make most of their money is on the SaaS model. The company's paying for their creative suite, managing the process of how the content goes out, gets published, and then analyze how the content does. They have 200 customers paying there, doing about, call it $20 million today in ARR, up from about 1.1 million in MR, so about 12, 13, 14 million just a year ago. They raised 20 million bucks, but again, to the point now where if they had to be in 6 or 7 months profitable, they could. Healthy economics, or they're working on these at least 71% gross retention and 90% net revenue retention, kind of quarterly. CAC $40,000 payback between 6 and 12 months with our team of 100 people based in New York City. Joe, thank you for taking us to the top.
Yeah. Thank you for having me.